Welcome to Ahead of the Curve from K33 Research. In today's market update, we'll look at the forces driving Bitcoin's recent weakness, why ETF flows remain a major concern, what institutional positioning is telling us, and why we believe caution is warranted in the near term despite maintaining a constructive long-term view on Bitcoin. Bitcoin experienced a difficult week, falling below $70,000 and recording its first double-digit weekly loss since February. While the price decline itself is notable, what stands out more is the market structure behind the move. Over the past week, Bitcoin ETF investors continued to sell aggressively. At the same time, institutional exposure through CME Bitcoin futures fell to its lowest level since October 2023. Meanwhile, open interest in perpetual futures increased and funding rates moved higher. Taken together, these developments point to a market where institutional participation is weakening while leveraged traders are becoming more exposed. In our view, that combination creates conditions for elevated downside risk in the near term. Despite our previous view that $60,000 likely marked a local bottom, current positioning suggests caution is appropriate. Let's start with what may be the most important development this week: continued deterioration in Bitcoin ETF flows. Over the past week, global Bitcoin exchange traded products recorded net outflows of 28,990 Bitcoin. Looking at a longer period, the past 3 weeks have seen net outflows of 62,794 Bitcoin. That represents the second worst 3-week flow period in Bitcoin ETF history, surpassed only by the peak outflow period seen during the first quarter of 2025. Flows began to deteriorate in early May as Bitcoin approached its 200-day moving average and the aggregate ETF cost basis. Since then, selling has become increasingly one-directional. One event that attracted particular attention was a $1.3 billion block trade in BlackRock's IBIT ETF on May 26th. According to our analysis, this was the largest Bitcoin ETF trade ever recorded. The trade coincided with Bitcoin's 7-day high near $78,000, after which prices drifted lower. The scale of recent outflows suggests that many investors remain reluctant to maintain Bitcoin exposure in the current environment. Part of the explanation may be technical. Weak momentum following Bitcoin's attempt to reclaim the 200-day moving average appears to have undermined investor confidence. Another potential explanation is opportunity cost. While Bitcoin has struggled, capital continues to flow toward areas perceived to offer stronger growth potential, including AI-related investments and several highly anticipated IPOs. As a result, some investors may be reducing Bitcoin exposure in favor of sectors that are currently attracting greater enthusiasm and stronger performance. Beyond ETF flows, institutional positioning is sending another important signal. As of June 1st, open interest in CME Bitcoin futures stood at 97,935 Bitcoin. That is the lowest level since October 2023. At the same time, futures premiums have remained subdued, with the 14-day average annualized basis sitting near 4%, the weakest 2-week average since September 2023. Part of the decline can be explained by outflows from futures-based ETFs. However, the majority reflects reduced positioning by active market participants. Historically, CME activity has been one of the clearest indicators of institutional willingness to take risk in Bitcoin. While today's market includes ETFs and ETF options as alternative vehicles for exposure, we still view the persistent weakness in CME positioning as evidence of limited institutional enthusiasm toward Bitcoin at current levels. At the same time that institutional exposure is shrinking, leveraged positioning in perpetual futures markets is moving in the opposite direction. Funding rates have repeatedly returned to neutral territory during the past week, something not seen since late January. However, the 7-day average annualized funding rate has climbed to 7.62%, the highest level since November 2025. Meanwhile, open interest in perpetual futures has continued to rise toward yearly highs. The combination of falling prices, rising funding rates, and increasing open interest creates a potentially fragile setup. In our view, This increases the risk of liquidation-driven downside volatility if prices continue to weaken. For that reason, derivatives markets currently reinforce the case for a cautious and defensive positioning approach. What's particularly notable is that this sell-off has not been accompanied by panic. Bitcoin spot volumes increased 38% over the past week, reaching $2.7 billion per day on average. However, despite that increase, volumes remain below the 30th percentile of weekly averages observed over the past year. Volatility also remains surprisingly low. Although Bitcoin has fallen sharply, both 7-day and 30-day volatility measures remain near the lower end of their historical ranges. Rather than a sudden panic-driven sell-off, Bitcoin has experienced a steady and persistent decline. The market has been grinding lower, with the majority of recent trading sessions closing in negative territory. The week also brought a headline that attracted significant attention across the market. Strategy, formerly known as MicroStrategy, sold 32 Bitcoin, only the second Bitcoin sale in its history. According to Strategy, the transaction was intended to demonstrate to credit rating agencies that the company can service obligations associated with its preferred share structure. We view the significance of the sale as limited. The transaction was very small relative to Strategy's overall Bitcoin holdings, and we continue to view the company's long-term objective as increasing its Bitcoin exposure over time. Despite the concerns we've discussed today, our long-term view on Bitcoin remains constructive. We continue to see Bitcoin as attractively priced and deeply undervalued relative to equities. However, the market currently faces several meaningful headwinds. ETF flows remain heavily negative. Institutional participation through CME continues to weaken, and leveraged traders have become increasingly exposed through perpetual futures markets. Until these trends begin to reverse, the market may continue to face pressure. So what does all of this mean? To summarize, our assessment is straightforward. Bitcoin remains attractive from a long-term valuation perspective, but short-term market structure argues for caution. Persistent ETF outflows, weakening institutional participation, and rising leverage among perpetual futures traders all point toward the possibility of further volatility and potentially lower prices ahead. For now, the evidence suggests that investors should prepare for a potentially choppy summer in digital asset markets. Thank you for listening to Ahead of the Curve from K33 Research. We'll be back with our next market update later this week.